This video will cover foreign currency markets. We'll motivate the study of foreign currency markets, which is not very hard to do. Recent statistics from the IMF, the International Monetary Fund, tells us that $6.6 trillion worth of foreign currency is traded per day. It's a huge market. And obviously, if it's a huge market for this currency, there's lots of financial institutions behind it to move that currency. This video will also help us understand, and as a prerequisite, the international central banking. We'll start off by defining the exchange rate, and we'll define that as E, and it's the number of foreign currency to $1. We'll talk about that a little bit more in depth. We'll talk about supply and demand modeling issues, which will help us better understand markets, currency markets. We'll discuss the drivers of exchange rates in the short run and the long run. I'll introduce the law of one price, that's for a single good, and then we'll ramp it up in aggregate, and that's called PPP, purchasing power parity. We'll define and interpret real exchange rates. We'll discuss government policy towards exchange rates and intervention. That is a prerequisite for the understanding of how international central banking works. And then we'll introduce interest rate parity and the math behind it. So let's start off by defining the exchange rate as the price of a dollar in terms of foreign currency. It's a relative price. Now I left out what most textbooks leave out. There's basically a 1 here. So it's the price of $1 relative to foreign currency. So it anchors on the $1. Now it's almost trivial to make a comparison here, but I'm going to do it anyway, just so we're sure we're anchored, because this is a relative concept. It's the value of a foreign currency relative to the US dollar, and it can be a little confusing. But if I tell you the price of a car is $20,000, right? Everybody understands that. But basically what we're leaving out is it's one car, the $20,000 per one car. So this is the number of foreign currency per $1. And so to go any further, I think we should make sure we have a handle on how this looks in terms of supply and demand. And that this is being a price. What is it a price of? It's the price of $1. So we put here E, just like when we've had the price of cars, I'll have the price of cars here, the number of cars on this axis, and we'd have demand and we'd have supply. Well, I'm going to have E, the price of $1. What am I going to have here? Down here, I'm going to have the quantity of dollars, and I'm going to have a demand curve, and I'm going to have a supply curve. So the way to look at this is the demand from foreigners. You can think of it. The best way to think of it is, the easiest way is to think of this as demand from foreigners. So when the price of $1 is expensive, when we're way up in this direction, there's not going to be much demand here in terms of quantity. There's not many dollars demanded. And when the price of $1 comes down, we slide down the demand curve and lots of dollars will be demanded. Now from the supply side, it's easiest to think of it as Americans supplying dollars to buy foreign currency. And so when the price of $1 is low, we're not going, which means, by the way, that foreign currency is expensive, we're not going to supply very much. And when the price of $1 is very high, it means the dollar can be translated into a lot of foreign currency, then we'll be willing to supply dollars to buy that foreign currency. So obviously you'll have an equilibrium, right, where supply equals demand for the dollar. And it's really important to keep in mind that when we're talking about financial institutions and even governments transacting in the currency markets, we're not simply talking about these organizations exchanging bundles of dollars, say, for bundles of euros. We're not even just talking about electronically shifting currencies around. We're talking about transactions that involve buying and selling of interest-bearing deposits. For example, if a business exchanges $10 million for euros, what will it do with those euros? Well, the answer will be it'll deposit them in an interest-bearing bank account, not just for safekeeping, but to avoid opportunity costs. It will then be able to easily transact business from those accounts. So keep in mind, underlying these transactions that we're talking about are interest-bearing deposit accounts. Think of it as being in a bank. Now, it's important to realize that we've defined the exchange rate E here to be consistent with its value. So when the value of the dollar goes up, E goes up also. If you flip it the other way around, which is sometimes common in other textbooks, in various websites and authors, if flip it around, you'll have an inverse relationship between the exchange rate and value. But the way it's defined here, it's defined that the price or value of the exchange rate is directly related to the value of the dollar. Now, let's actually use this graph to talk about shifts in the exchange rate. What drives this exchange rate from a supply and demand perspective? Okay, the first one is expected domestic price level. If the expected domestic price level goes up, in other words, in English, inflation in this country goes up relative to foreign inflation, what we'll have is we'll have supply of dollars will move out to the right here, down and to the right, and the value of the exchange rate will go from here down to a new point, say right here. That's because basically what's happening is in our country, the value of the dollar is falling. If you have inflation in this country, it buys less goods and services. Well, then all else being equal, as Americans, we're going to want to move and flip over into foreign currency if we can, because that foreign currency is depreciating less. So we supply our dollars, and it's a shift in the supply curve. Now let's back up 1 second and ask ourselves, wait a second, what's a shift versus a movement along one of these curves? Well, remember from basic economics where we have prices and the quantity of cars here. So if the price changes only, you move along the supply or demand curve. So when prices rise, all else being equal, demand will shrink off to the left and will move up this demand curve here, meaning quantity of cars demanded will be less. If the price of cars goes up, the quantity supplied will go up because manufacturers will get a higher price for it. Then they're willing to supply more cars. So you move along these lines when price changes, or in this case, when the value changes or the price of the dollar changes, you move along these demand curves. But here we're talking about an expected domestic price level increase, inflation relative to foreign inflation going up. That's not E changing, but E will change as a result of it, because we're going to shift and the supply curve down because we're going to supply more dollars to buy foreign currency. Now the next one is, let's imagine what happens if trade barriers increase. And from a domestic perspective, trade barriers, you don't erect trade barriers for exports generally, unless it has a national security issue. Trade barriers mean tariffs on imports. So if our trade barriers go up, then that means we're going to stop buying foreign goods. We're going to at least slow down in buying foreign goods. It's going to shift the supply curve up and to the left, and the exchange rate, all else being equal, is going to go up. Now, we have an increase in the preference for foreign goods. If suddenly, as Americans, we find foreign goods attractive, then what we're going to do is we're going to supply our dollars to buy the foreign currency to get that good. And so that's going to shift the supply curve out and the exchange rate down. The value of the dollar will fall. Now, if there's an increase in the wealth of Americans, if we become more wealthy, then we're more likely to buy goods and services from other countries. We're going to supply our dollars and push the value of the dollar down. Now, if there's a decrease in the riskiness of foreign assets relative to U.S. assets, so foreign assets become less risky, well, they become more attractive suddenly, right? So we're going to buy more of them. We're going to supply dollars to buy those foreign assets, shift the supply curve out, down, and to the right, and then the exchange rate of the value of the dollar will fall off. Now, let's consider what happens when we have an increase in U.S. productivity. An increase in U.S. productivity means that manufacturers from this country can produce goods at a cheaper price using the same amount of raw materials and inputs, or they can produce a better unit with the same inputs. That's what an increase in productivity means. Basically, it means that prices for U.S. goods are now cheaper than foreign goods. So that means we're going to supply less dollars to buy foreign currency, and so the supply curve is going to shift to the left. The value of the dollar goes up because basically going to keep our money here in the States and buy our goods rather than foreign goods. And the last one we have is an increase in the real interest rate on foreign bonds relative to U.S. bonds. Just think of it as a change in interest rates. So what do we mean by real interest rates? Well, remember, the nominal rate equals a real rate plus an inflation premium in the simplest form. And so what happens is we're talking about real interest rates going up, keeping inflation constant, which means nominal rates have gone up. So if interest rates have gone up, then what does that mean? Well, interest rates for foreign bonds go up. It's going to push this supply curve out as we're going to want to buy those attractive real interest rates. So we're going to supply our dollars to buy foreign currency to buy the foreign bonds. And that'll drive E down, the value of the dollar down. So you can see that's a very convenient way of analyzing and structuring an analysis of what moves the dollar up or down, or a currency up or down. Now, if you want to know what moves the demand curve here, then all you have to do is think of yourself as a foreigner and look at the same analysis, the same list, which I'll put up on the screen in a second, the same list but from a foreigner's perspective. And that's what happens with the demand for the dollar. So that's a good exercise for you to do since you basically know the answers. And so go through the mental exercise of going through those changes and being able to predict what happens to the value of the dollar. It's very intuitive. So while the list itself may not be intuitive, once you hear a particular item, it should be intuitive. For example, if the inflation rate goes up in this country relative to another country, the value of our currency is depreciating domestically, and it's also depreciating from a foreign currency perspective. So here we have a nice summary of the exchange rate drivers focusing on supply shifts. Now there's two things that are missing from this table. The first one is that we've left out the idea of speculation. There's a lot of speculation in the foreign currency markets that can shift exchange rates very quickly. And it's very hard to explain. It's hard to pin down the exact reason for it. But there will be shifts in the exchange rate because of speculation. The other thing is there's central banks occasionally intervening in the currency markets. That can shift exchange rates significantly. But this chapter deals with basically economic explanations, private economic explanations for changes in exchange rates. It's not public policy. Policy will be covered in a later chapter when we looked at international monetary policy, because countries have reasons for shifting and changing their exchange rates and possibly devaluing them. It's a subject of a later chapter. Now, one more thing with respect to expected domestic price level increases. That's expected now, right? So this is current exchange rate right now. So if we expect inflation to go up, then we're going to supply more dollars and we're going to move out in this direction. The exchange rate goes down. This is the current exchange rate. It's not the future exchange rate. It's the current exchange rate. And it'll push the value of the dollar down. What that does is that introduces the idea of current exchange rates and future exchange rates. In other words, forward exchange rates. Let me go over that concept because it's important to know the distinction between what's called a spot exchange rate and a forward exchange rate, especially when it comes to buying foreign securities and then having them mature and having to bring our money back into this country. Let me explain. Probably the best way to introduce forward exchange rates is to compare them to spot exchange rates on a timeline. So we always start off at time 0, that's right now, and this could be a week, this could be a day, this could be 1 month, this could be 1 year, but let's stick to a year. Conceptually probably the easiest. Now, if you buy currency right here, right now on the spot, and you flip your dollars into yen, that is literally called a spot exchange rate that you'll be exchanging your currency for. So if you were to fly to Tokyo and you'd get out of the plane, go into the airport, and right there on the spot, you'd be giving up your dollars and you'd be getting yen so you can travel throughout Japan. That's in a spot exchange rate. But our financial markets are fairly sophisticated, and you can enter into a contract right here to exchange currency here. You can lock in an exchange rate right here for 1 year from now. Now, in 1 year, anything could happen to a currency, and it could appreciate, depreciate, and what I'm saying is you end up with a lot of risk. If you know you're going to need yen at this point in time, you don't know how much it's going to cost you when you're sitting right here at this point in time. If the dollar depreciates substantially relative to the yen, it's going to take a lot of dollars to buy a yen. And so things could work against you. And remember, we talked about all the different economic explanations on what drives exchange rates. Well, a lot of that information comes out randomly over time. We don't know what the inflation rate will be over the next year. We could be shocked and surprised at what that inflation rate will be, or at least the relative inflation rate. Remember, it's relative. Or what the relative real interest rates are from one country to the next. We just don't know. So the point is, there's a lot of randomness in the exchange markets, and there's a lot of risk. So why not enter into a contract here, right, to exchange currency in the future? At least you've locked in an exchange rate. You know exactly what you're going to pay for it. That's what we call a forward market. So you enter into the forward market here at this point right now to exchange in the future. No money changes hands at this point when you enter into a forward contract, because you've entered into a contract. You just agreed to exchange at this point in time. Now, why would anybody want to do this? I mean, obviously it's to get rid of risk, but let's look at a couple examples. Let's say you're sitting right here and you're going to import cars worth $500 million in yen. And you want to have the dollars to be able to do that at this point in time. But boy, you don't know how much that $500 million yen is going to cost. So you're going to buy yen at this point in time so you can buy the cars, import them into our country, into the US. Well, that's a lot of exchange rate risk. You better be prepared. And how do you become prepared? You enter into a forward contract here to exchange dollars for 500 billion yen 1 year from now. That will reduce your risks. So that's one example. You have a specific transaction you want to hedge. It's called foreign currency hedging. The other thing you could do is, look, you could buy a Japanese investment like a bond. So right here, you buy a Japanese bond, and you're going to have to buy the bond you're going to have to flip your dollars into yen to be able to buy the bond in the spot market. But look, you're going to hold this bond for this whole period. It's going to accumulate interest at a Japanese interest rate. And then you plan to flip this over once you convert it into dollars once it matures. Well, how much is it going to be? How many dollars are you ultimately going to get back? Well, you don't know, because you don't know what the exchange rate will be 1 year from now. So to hedge your risk with respect to that investment, you not only go into the spot market to be able to buy the investment, but at the same time, you enter into a forward contract to exchange the amount of the maturity here 1 year from now. And so that way you eliminate interest rate risk there. And you might be able to get a good interest rate in Japan. But yeah, probably not. Interest rates in Japan have been notoriously low for a long period of time. Just an example. So let me be clear here now. There's two different ways you can make an investment at this point in time in Japan. So let's look at this investment example. You could buy the Japanese bond right here at this point, carry it for a whole year, and then whatever the exchange rate is, you don't care, you flip the yen into dollars once the bond matures. That's called uncovered investment. It's not covered. The exchange rate is not covered. We haven't reduced the risk associated with the exchange rate. So it's what's called an uncovered transaction. We could cover it, and that's what I meant when I talked about entering into a forward contract. That's called a covered investment. You've covered your exchange rate risk. I'll have a little bit more to say about that, because there's an equation that goes with it that shows you some math and some concepts. Parity. So we're going to look at covered interest parity concepts and uncovered interest parity very briefly towards the end of this video. So now let's move on to the concepts of long run and short run exchange rates. And before I go any further, let me draw you a graph of what I mean by, at least visual, so you can visualize what I mean by short run and long run exchange rates. So here we have E, the exchange rate. Here we have time. And you know, exchange rates, they vary frequently. You know, they have quite a bit of volatility. So this would be the actual exchange rate. But you know, that exchange rate is hovering around some type, there's basically an average that's going on. And so we consider that average to be a long run exchange rate. So why do we call that a long run exchange rate? Well, what you have is you have an actual exchange rate that's quite volatile, that seems to want to hug this long run exchange rate. This long run exchange rate is not observable. You have to estimate it. And that's what we're going to get to here in a second. So what you have here is you have what's called short run deviations from a long run exchange rate. So on average, this is where the exchange rate will be. Sometimes the exchange rate's well above, sometimes it's below, but it kind of ends up, you know, mean reverting, so to speak, to this long run. So these are deviations. That's what we mean by a short run exchange rate movements and long run. So even in the long run, there's movements a bit in the exchange rate. You see a little bit of upward slope here, and then it flattens out and so on. So even the long run can change, but the big changes are these short run deviations from the long run. So now the question is, what is driving this? Well, that's where the law of one price comes in, and then we're going to ratchet it up to purchasing power parity. But before we actually do that, let me just talk to you about what's causing these changes. Well, a lot of these changes are, you know, sudden shocks to interest rates, relative interest rates. It could be the wealth to some degree, productivity shocks, things that we talked about when we talked about supply and demand moving earlier. That's what can cause these changes. Okay. Now, the thing here is this long run is going to be driven by relative inflation, relative price indexes that we looked at and discussed a little bit earlier. Because remember, we said that relative prices, relative inflation, I should say, relative inflation can drive exchange rates. Well, it's this relative inflation, relative price indexes that you can think of as being this long run exchange rate. So let me elaborate on it. And first I want to get into the law of one price and then ratchet it up to purchasing power parity, as I said a second ago. So the law of one price, so I'm modeling the long run exchange rate, this unobservable exchange rate that seems to be fairly steady. And I'm going to talk about the law of one price to start it off with conceptually. The law of one price says this. It says, look, if you take the price of some good denominated in pounds and you multiply it by the dollar-pound exchange rate. This is just E flipped. This is just 1 over E, by the way. It's convenient to write it that way, and I'll explain it in a second. But you take this, the price of this good measured in pounds, multiply it by the exchange rate, and it comes out to be the dollar price of it, right? So what we're saying is if the law of one price holds, then this should equal. There should be an equal sign here. In other words, the price of a good, regardless of what country you're buying it from, should be the same once you adjust for exchange rates. That's what we mean by one price for a good. Now, the goods have to be identical. It's important that we have identical goods, and there's no trade restrictions or barriers or taxes or transactions costs, because that'll throw a wrench in the relationship. I mean, if you can imagine trying to buy something with a really heavy tariff on it, this is not going to hold. In fact, it may not hold because there may not be any transactions involved at all in the first place. So how is this going to work? How does this work in the first place? Let me give you an example. Suppose a polo shirt costs £40 in England. What's the price going to be in the United States if the exchange rate is 1.3? 1 pound to $1.3. Well, the price is going to be $52. And by the way, one of the tricks to this equation, this equation should be relatively intuitive. Think of this as a numerator, the top, and this is the bottom. They both cancel out, and you get dollars to dollars. And that way you know you got this equation straight. So what we're saying is, look, if there's polo shirts running for £40 per shirt in England, they should cost $52 in this country, provided we can exchange them back and forth and trade them back and forth without restrictions. And they're identical shirts. And the reason for this theory, this law of one price is a theory, the reason for it is if this didn't hold, what you could do is buy the shirts that are cheap. In whatever country the shirts appear cheap, buy them and then export them to the country where they're expensive and sell them. And what you'd end up doing is by buying them in the cheap countries, you drive the price up in that country. And by selling them in the expensive country, you drive the price down to eventually equalizing so that there's one price for that good. And not just between two countries, but around the world. That's the theory. Now, let's take that theory one more step, a big step. And let's take it and look at this law of one price for the entire economy, aggregated up. And so probably the best way to do that is let's start with this equation right here and say, look, we can rearrange this. So we got dollars to the pound equals the price in dollars and the price in pounds. So what we have is the exchange rate is a function of the relative prices. Okay. Now, this worked for a shirt. Why can't it work for an entire economy? That's what economists think. I mean, it's a heroic leap, but nevertheless interesting, because what we can do is we can replace these guys with the CPI measured in dollars, the Consumer Price Index measured in dollars, divided by the Consumer Price Index in pounds in England. This is in the United States. This is England. And now look what you have. You have an example of relative prices driving exchange rates. And so when this relationship changes, that's inflation. That's relative inflation. When this number changes, this whole number here, the whole fraction changes, that's going to drive the exchange rate, as we talked about earlier. So let's flip this over for a second so it's a little easier to interpret compared to what we did earlier. So flip this over. CPI pounds and CPI dollars. And there you have the relationship now. Maybe it makes a little more sense to you. Is that, look, if inflation in the U.S. goes up, so the CPI in the U.S. goes up relative to the price index in the UK, then this whole fraction right here is going to get smaller, and this exchange rate's going to drop, and the value of the dollar is going to be less because we have US inflation that's higher than UK inflation. The value of the dollar is going to drop off. So there's a motivation for talking about relative prices right there. It's the law of one price applied in aggregate. Now, the law of one price is called PPP, purchasing power parity. Okay, so your purchasing power, your money in one country, should be able to buy the same amount of goods in another country once you adjust for exchange rates. Now, let's go to another concept called real exchange rates, using this example we just had. So the real exchange rate is defined as, in this case, a dollar price of a polo shirt in the US divided by the dollar price of a polo shirt in the UK. That would be the real exchange rate. Now, this is in dollars, this is in dollars. The dollars cancel out, so there's no real units associated with this real exchange rate. But the real exchange rate is telling you, if we could exchange shirts from one country to the next, what would be the number of units of shirts that we could move from one country to the next? Well, if the law of one price holds, then this equation will equal 1. Exactly 1. One shirt can be exchanged for one shirt. And you could trade without worrying about currency or exchange rates. You just literally barter, in a sense. So you get 1 for 1. And we know it's 52 divided by 40 times 1.30, and that's where we get the 1.0. So you remember where that math's coming from. So no units here. If it turned out this is 1.5, then the relative prices of a polo shirt would be 1.5 times higher in the US than it is in the UK. Yeah, now listen to that. That's important. If this number is 1.5 for the real exchange rate on polo shirts, it means that US exports of polo shirts are expensive. And if that exchange rate, that real exchange rate increases, it means our exports, US exports, are becoming more expensive. That's an indication of how competitive we are from a country perspective. So you can look at this real exchange rate on a unit by unit basis, meaning a good at a time. You can look at it for aggregate goods also. And it'll tell you whether or not we are competitive for importing and exports. Are we competitive on an international basis for trade? And if the real exchange rate appreciates, at least the way we defined it to be, then we are less competitive as a country. Now, let's look at exchange rates empirically. Do they behave like I was saying earlier? That look, we have actual exchange rates. They tend to be volatile over time. There's a long-run exchange rate that's kind of smooth here. Kind of think of it as an average over time. Does it line up? Does this long-run exchange rate match up with what we talked about, purchasing power parity, relative price indexes? Well, we can do that looking at FRED information, the Federal Reserve economic data from St. Louis. Let me show you. So here we have the British pound and the US dollar and PPP. PPP is represented by that blue line that kind of cuts the actual exchange rate in red right down the middle. And so that blue line is estimated by taking the UK Consumer Price Index divided by the US Consumer Price Index. So that blue line is what we talk about, what we refer to as the long-run exchange rate. It seems to be what the actual exchange rate wants to hover to or revert to, sometimes called mean reversion. Once it's above, it tends to be pulled down, and once it's well below, it tends to be pulled up. And so it keeps crossing that blue line. So you can see exchange rates can be quite volatile over time, and relative prices are not that volatile. So what it tells you is that, look, exchange rates are driven in part by relative prices, for sure, but there's lots of other things like we talked about that can move exchange rates in the short run, including speculation, including government policy, which is discussed in another chapter. So I think there's 2 points that are interesting in this graph. Is one, look at the big spike in 1985. That's a weakness in the pound relative to the dollar. We had just come out of a really severe recession in the early 1980s. Ronald Reagan was president at the time, and we had a big tax cut in this country, and so the world was looking at us and expecting a very strong economy. And so you had speculators bringing up and driving up the price of a dollar significantly relative to the pound. The UK's economy just didn't look as good as the US at that particular point in time. So speculators in the currency markets drove up the dollar and drove down the pound. And basically the value is inversely related there for the pound. The other interesting thing is look at 1975. It's 76 and 77. You see relative prices changing significantly between the two countries. And that's why you have that steep upward slope starting in 1975. That's because of UK prices their price index ramped up significantly relative to the U.S. price index. And so when that happened, the currency should weaken. And it did. You can see, as you can see the red line, it spiked up too. It turns out that the OPEC oil crisis that happened in 1973 and 1974, which drove up oil prices significantly, impacted Britain much more than it did the U.S. And that accounts for the increase in the consumer price index for the UK relative to the US. So interestingly, it took a while for that spike in oil prices to make its way through the entire economy and have the aggregate price indexes increase. That's interesting because, as we'll see later on, when the money supply increases, inflation goes up, but it doesn't happen immediately. So any introduction to the currency market's not really complete unless we talk about countries intervening in their currencies. They occasionally do that, depending on certain situations of what's going on in the economy. In the UK, for example, in 1992, September of 1992, speculators pushed down the value of the pound significantly. You see that spike, that upward spike, that's a depreciation of the pound. And the reason for that was the UK had fairly high inflation at the time relative to Europe, especially Germany. The inflation rate was about 3 times higher than it was in Germany. And the British pound was locked into a trading band relative to European currencies under what was called the European exchange rate mechanism. To make a long story short, that exchange rate mechanism was designed to keep the pound within a narrow trading band relative to European currencies, because the thought was that eventually Britain and other European countries would merge and have a euro. This is 7 years before it actually happened. And if you look back in history, there were numerous times when the various countries in Europe tried to get together and develop one currency, only to have it fail for various reasons. So in this case, what you have in 1992, you have George Soros shorting currencies, meaning he was basically driving down the value of the pound. And it got so bad that the central bank, the Bank of England, had to intervene in the currency markets and buy up the pound. You buy up the pound to try to stabilize it. And you can see the impact hit there. You can see a sharp downward drop in that red line a bit, and then it stabilized. So it looks like the intervention worked for that instance. Other times countries get involved in exchange rates intervention, and they just can't handle the actual markets. So remember, I told you the currency market today is $6.6 trillion per day traded. There's no central bank in the world that can actually handle that and try to offset some of the volume of trading that goes on in their own currency. And so sometimes they just have to let it crash. And that's usually what it does. Usually the currency will end up crashing because people lose confidence in the country's economic policies or its political policies. So nowadays, often when you see intervention in the markets, it's numerous central banks intervening, because we know that just one central bank, even our Fed, is not big enough to be able to manipulate the market if it's crashing or it's moving significantly in a certain direction. So if you got the backing of, say, a half a dozen central banks around the world intervening to prop up a currency, traders look at that carefully. It's like, well, okay, we're not going to be able to compete against a half a dozen central banks. They're going to push that currency where they want to. So that said, nowadays there's really not that much intervention in the U.S. dollar. And it turns out one of the reasons for that to be is that, one, we're relatively stable. The economies are relatively stable across the countries, the major ones. So there's not much reason to intervene. But also there's intervention that goes on from other countries. The U.S., our central bank, doesn't usually intervene that often because we're the major player in the economy, world's economy. And so what happens is, if there's an exchange rate that's kind of getting out of whack, it's the other central bank in the other country that will intervene to try to move the currency. The U.S. just observes what those other countries are doing, and we don't actually have to get involved because our trading partners end up getting involved in the currency markets. It's kind of convenient. So what I'm doing is I'm giving you a taste of international monetary policy. Yeah, monetary policy. It comes up later in this course, and international monetary policy is almost at the end. So when countries interact in their currency, they're affecting the monetary policy of their country relative to the rest of the world. And the implications are important for the country and its interest rates and economic growth. So that's why we're going to look at it later on in the course. So moving right along now, let's talk about interest rate parity. Another parity condition, we looked at purchasing power parity, where related aggregate price indexes to exchange rates. What we're going to do now is look at how interest rates are related to exchange rates. And let's go on to, let's assume for now we want to invest in a foreign bond today. There's at least two sources of returns and risk, by the way, over the next year, say. So let's say we want to buy a bond, a foreign bond, and hold it for 1 year. Two sources of returns, and the returns are this. We'll designate one as IF, and that means that's the interest rate on the foreign bond. Okay, well, that's pretty obvious. You're going to earn the interest rate on that foreign bond, but you're also going to have an exchange rate gain or loss on that. So when you buy a foreign bond, you get this foreign rate of return, plus you have an effect of the exchange rate either going for you or against you. And this is how we're going to capture it. So this is in percent here. Think of this as a percentage, and this is a percentage. This is your capital gain or loss on the exchange rate over time. And so we're looking here, timeline, 0, 1. So often, I start off at 0 and 1 here for a 1 year period. And we could just call this period T and T plus 1 to make it more general. So at any point in time, you can invest, and then you bring your money back home, so to speak, when the foreign bond matures. And so this is our return associated with investing in a foreign bond. So these are two components of return. Well, there's two components of risk. That interest rate can change, and so can exchange rates. So what we're looking at is, look, interest rate parity. What we're going to say here is that the interest rate that you earn on a domestic bond should equal the interest rate you earn in a foreign bond minus the exchange rate gain or loss. That's the parity condition, that these equal. So in other words, it doesn't matter where you invest your money. Once you adjust for exchange rates, you're going to get the same return. So the assumption for this equal sign to happen is that we need to have perfect capital mobility between countries. In other words, you can move money back and forth between countries easily. And the assets between domestic and foreign countries are perfect substitutes. So the asset that we're looking at and thinking about here in the bond is they're perfect substitutes, meaning investors view them essentially as the same. So now let's actually do an example that'll make more sense. Suppose that the interest rate on a foreign country's 1 year government bonds is 5%. Ooh, okay, so as soon as you start getting numbers, plug them in. Interest rate on the foreign bond is 5%, while domestic U.S. government securities interest rate is 2%. Assume perfect capital mobility and perfect substitutability between the assets. If interest rate parity holds, what is likely to happen to the exchange rate between the countries? Well, for this to hold, right, you know that this capital gain or loss has to be 3%. So how do you interpret that? Well, look, before you put the negative sign in there, just look at the 3%. It says, look, the value of the dollar has appreciated 3%. So what it means is you invest here, and so you're picking up on this ET, the exchange rate at time T, and then you're going to convert your money back into dollars a year from now. And what we're saying is the value of the dollar has appreciated 3%. So when you go to convert your money back into dollars here, so you go to bring it back into dollars, you're going to have to pay 3% more to do that. And so that's going to hurt your return. So that's why there's a negative sign in front of it. And the driving force behind this is sort of like what we talked about when we did purchasing power parity. It's arbitrage, except the arbitrage conditions here are even more powerful because money can move. It's mobile between countries much faster. You can move lots of money from one country to the next. And so this relationship is driven by arbitrage conditions. So this is another very powerful parity condition for exchange rates. And economists view this as another long-run condition, another long-run relationship that's built within exchange rates. So when you look at exchange rates over time, that interest rate parity drives exchange rates over the long run. The problem is, it's a little more complicated than that because interest rates can change on a dime. They can change very, very quick. Aggregate price indexes for all goods and services, that's generally slow to change. But interest rates can change really fast. And so this interest rate parity condition helps explain the stable long-run interest rate. That can help explain it along with purchasing power parity. But interest rate parity can also explain short-run movements too. Now, what's interesting here is there's two forms of interest rate parity. There's uncovered interest rate parity. That's exactly what we're looking at here. It's uncovered because I've left myself exposed to exchange rate risk. What do I mean by that? Well, I bought the foreign investment right here. I held the foreign investment, and now I'm going to flip it back into dollars. I have this exchange rate risk. And that's what we mean by uncovered. I haven't covered my risk associated with exchange rates. That's what uncovered parity means here. It means that, look, when I did this, the exchange rate that was, it's important to get a handle on this exchange rate. This is an expected exchange rate. So for this relationship to hold, right, I'm anticipating that this relationship will hold. I'm going to get the foreign bond yield, and then I expect to get this loss from foreign exchange, so that the return of 2% is what I'm going to get ultimately. So what I'm saying is that foreign yield may look really attractive, but it's really not once you adjust for exchange rates. Now there's another version of interest rate parity, and that's covered. And the way you cover this is using forward rates like we looked at earlier. So you can enter into a forward rate contract here. So you buy the foreign bond here, and at the same time you enter into a forward contract on exchange rates, so that when your bond matures, you're going to convert that into dollars based on that forward rate that you lock in right here. So you lock in a forward rate here, things actually transact here. So you're going to get that proceeds from the foreign bond, you're going to convert it into dollars at the forward exchange rate. So that's covered interest rate parity. What it does is it eliminates the risk associated with exchange rates. You're still going to have, most likely, a gain or loss on the exchange rate, because the exchange rate that you have here is not going to equal the forward rate that you're going to have at this point. Most likely. I mean, it could, by happen chance, be the same exchange rate. The exchange rate here and the forward exchange rate for 1 year from now could be the same thing, but highly unlikely. So you're going to have an exchange rate gain or loss, but there's going to be no risk associated with it, because you're going to know exactly your gain or loss on the exchange rate right at this point. So basically, when you're looking at a covered interest rate parity position, there's no risk associated with it. You know the interest rate you're going to get because we bought a government bond, right? So we're going to get risk-free interest rate over this time period, and then the exchange rate's going to be flipped over and converted using a forward exchange rate. So we're covered there. And then so this side is risk-free, and so is this side. So let's take things one step further and ask, well, where does that forward rate come from in the first place? Well, let's think about that. You know, if you're trading right here, if you're a currency trader and you're making trades that happen right here for contracts that are going to be fulfilled a year from now, then it's the transactions that are happening now, people entering into forward rate contracts now, that's going to determine that forward rate in the future. So what I'm saying is, think of it this way, is they're basically a supply and demand diagram for currency in the future. And what that boils down to is that, look, see this guy right here? This expected exchange rate that we were talking about, that's basically the forward rate. That's the place to start to determine where a forward rate's going to be. Because if you believe in interest rate parity, and that capital can move easily from country to country without very much restrictions, which is fairly true amongst developed countries, then if that parity holds, then this exchange rate will be the forward exchange rate. And if it's the forward exchange rate, then you can't take advantage of, there's no arbitrage conditions to try to take advantage of the situation. Because if you enter into this investment, it doesn't matter if you invest in the foreign country or the domestic country, you're going to get the same return. And so this expected exchange rate is the forward exchange rate that makes this equal sign happen. So the whole reason I covered interest rate parity and actually am showing you this formula is because the last quarter of this course is about monetary policy and how monetary policy affects interest rates. Well, it's affecting this interest rate, which means it's going to affect this side of the equation. It's going to have an effect on foreign interest rates, and it's going to have an effect on exchange rates. And not only that, exchange rates and foreign rates can have an effect on domestic rates also. So my point was to have you become aware of this equation and these relationships that are going on in the economy, that there is an interesting relationship between domestic interest rates, foreign interest rates, and exchange rates.